This is MacroVoices, the free weekly financial podcast targeting professional finance, high net worth individuals, family offices, and other sophisticated investors. MacroVoices is all about the brightest minds in the world of finance and macroeconomics telling it like it is, bullish or bearish, no holds barred. Now, here are your hosts, Eric Townsend and Patrick Serezna.
Listeners, you're going to find the download link for the post-game chart deck in your Research Roundup email. If you don't have a Research Roundup email, that means you have not yet registered at MacroVoices.com. Just go to our homepage, MacroVoices.com, and click on the red button over Jeff's picture saying, looking for the downloads. Now, Eric, let's cover crude oil starting with the EIA inventory.
EIA posted builds across the board, with crude oil building 3.7 million barrels. Cushing, Oklahoma drew down 1.6 million barrels. Gasoline building 2.6 million barrels. Distillates building 881,000 barrels for a net petroleum build of 7.2 million barrels, with U.S. production ticking back up 100,000 barrels to 13.2 million barrels. The market seems to have found its bottom and is trying to recover, but I'm still not holding my breath for $100 oil prices. We've got so much spare capacity in the system, and so far we're just not demanding enough. Now, I think in the next couple of years that's going to change. We're going to get into a real global energy crunch, but it's not time quite yet.
Well, Eric, I just wanted to highlight a quick thing on the oil chart. Now, we had a very nasty drop in oil markets the other week. And when you have a mean reverting rally of the magnitude we saw this week, where we almost reversed the entire sell cycle of the late May sell-off, it to me is at least showing that the fair value of oil is much closer to 80 than it is down to the low 70s. What I'll be looking for in the next couple of weeks going into early July is whether or not the price action stabilizes up in these levels, indicating that there isn't another leg down in the crude oil sell cycle. The more we see price action stabilization, the more we can speculate that the short-term lows in oil are in, and that could lead to buying opportunities in July and August. Now, let's get Nick involved in this conversation. Now, Nick, on pages 3 and 4, we have the S&P 500 and the QQQ levels. What are the levels you're watching, and what are you thinking of the markets here?
Yeah, Patrick. So right now on SPX, we have a spot price of approximately 54.20 and an implied move for next Friday, June 21st, OPEX of plus minus 60 points. Therefore, the upper implied move is 54.80. And the lower implied move is 53.60. Right now, we have no key resistance as we're at all-time highs, and we have key support at 53.50. On Qs, we have a spot price of 477 and an implied move of plus to minus 7 points for next Friday's monthly OPEX. Therefore, we have an upper implied move of 484 and a lower implied move of 470. Right now, I think we see that blow off top toward that 5,500 mark. I don't really see us pushing much further than that level, though, in the short term. Possible test of 55.50 or so, but I do see us having a small pullback thereafter, somewhere around that 5,300 mark overall. I'm looking at names like NVIDIA right now after the split. It should still run to the upside. Apple has had a monster run the last couple of days as well, gaining about 12%. One interesting thing to note is that over the past year or so, the top 10 companies in the S&P 500 have accounted for about 2,000 points in the S&P. So if you were to measure those companies on their own, separate from the remaining 490 names, they would be at around a level of 8,000 on SPX, whereas the remaining names would be at around 4,000 and change. So interesting to note that because we're seeing a very top-heavy market. I want to look for more broad-based buying in the small caps if we're to see a further leg higher.
Well, needless to say, the melt-up in equities is continuing this week. But Patrick, you're the options hedging guy. I know you did a special webinar for our MacroVoices listeners back at the start of the year discussing that it's never been cheaper to hedge your portfolio. It seems to me like now is a relevant time for fully invested investors to consider doing exactly that, managing downside risk without having to sell their holdings. Because quite frankly, I don't think these absolutely guaranteed certain to to happen no matter what. Rate cuts from the Fed are really all that certain to happen no matter what. And if they don't, I think we could see some volatility in this market. So is the opportunity to hedge still as cheap as it was at the start of the year? And what's the update generally on that strategy?
Yeah, Eric, it's still an incredibly cheap period to hedge downside risk with a number of interesting strategies. Before I get into the details, I wanted to discuss for a moment the principle of the pain trade that only the seasoned MacroVoice investors understand through experience. The pain trade in investing refers to a market scenario where the majority of investors are positioned in a particular way, but the market moves in the opposite direction, causing widespread financial losses. The term captures the idea that the market often takes the path that causes the most discomfort and financial pain to the largest number of investors. Back in 2023, there was no shortage of bears anchored off the regional bank failures and the yield curve steepening. But I was skeptical almost solely on the simple principle that markets rarely have big downside moves when a large number of investors are expecting or planning for it. The greatest downside risks are almost always associated around periods where investors are all crowded in on the wrong side of the trade, and liquidity events are almost always associated with that crowd all being forced to sell at the same time. Now, historically, nearly every interest rate cutting cycle has coincided with a recession either just before or shortly after the rate cuts begin. This pattern can be observed in the years 1974, 1989, 2000, 2007, and 2019. Recessions typically follow a period of tighter financial conditions due to rate hikes, with the subsequent rate cuts eventually loosening financial conditions and aiding the economic recovery. Despite this historical trend, the Federal Reserve Chair Jerome Powell and many mainstream analysts are optimistic that the current cycle may break from this pattern and a soft landing or no landing scenario. Should you trust this optimism? Is it really different this time? Is it now time to sell assets and raise cash? It has never been more affordable and strategic to insure your portfolio. Many investors face challenges in selling core securities, whether it's due to tax implications, trading restrictions, or the complexity of such decisions. This is why portfolio insurance through hedging is an effective strategy for managing your portfolio risks. There are two key drivers behind the cheap portfolio insurance: low implied volatilities and high interest rates. Most people track the VIX, the 30-day volatility, but on page 5, I have the chart on the 1-year VIX, looking back close to half a decade. We are at the lowest levels of implied volatility in the post-COVID timeframe. Investors can execute a simple trade like just buying the downside gamma. But what other strategies can you consider for mitigating the costs? What time frame should you hedge? What strikes should you consider? There are many important questions that deserve a much deeper conversation than a quick mention here in the post-game conversation.
Now, you're hosting a special webinar to go deeper into the current market conditions. When is that, and where can people register?
On Tuesday, June 18th at 11 a.m. Eastern Standard Time. The link is in the Research Roundup email, but you can also register by just simply going to the website, bigpicturetrading.com.
And for any listeners who are unable to attend live, will there be a recording available?
Yes, anyone that registers for the event online will be able to access the recordings for the live session if they're unable to attend.
Looking forward to that webinar, Patrick. Let's get through the rest of the chart deck, starting with the US dollar.
Yeah, Nick, it's been absolute confusion on the dollar over the last week. We had the ECB, we had the European elections, and then subsequently the CPI numbers and the Fed, which basically have seen huge whipsaw in both the euro, the US dollar, and many other cross currencies. At this juncture, I wouldn't classify any of this as a breakout. So while it's been stuck in this range, we still are going to be watching for when the dollar makes a commitment to a trend breakout, which simply hasn't emerged yet.
And moving on to page 7, we have that gold futures chart. Eric, what are your thoughts here?
Wow, what a difference a day can make. As of Thursday, The gold chart was looking terrific, just powering ahead. I thought we were headed toward new all-time highs again. But as Jeff mentioned in the feature interview, what everyone's attributing this big $100 shock move down last Friday to is China's announcement implying that they may have paused buying more central bank gold reserves. Frankly, I don't think that explains the move. Maybe that was the catalyst to get it started. I think probably this mostly has to do with the market finally pricing out any hopes of rate cut expectations. The China announcement, as far as I can tell, was just the catalyst that got the ball rolling. The next obvious support comes in at 22.85, but frankly, everybody's talking about that. There's a support level at 22.85. Well, hang on a second. The 22.85 support level really only shows up on the continuation chart. My general rule when the continuation and contract charts don't really jibe is the contract chart for the front month futures contract is the one that wins. And when you look at the front month futures contract in gold, we've already retested that low from April. It's not 22.85 on that chart. It's only 22.85 on the continuation chart. On the contract chart, we're already there, and there is no further support all the way down to 22.56. So is there really a support level below the market at 22.85, or is the first significant support not coming until 22.56? I guess that depends on which technician you're talking to, but I see it as really no substantial support until 22.56. So let's see what happens. It might be that it's already over. Frankly, I didn't expect the big $100 correction to happen when it did. Maybe it was just a panic that's going to come back out of the market after we got a little bit of a dovish surprise from the FOMC this week. We'll see what happens.
Well, Eric, in my mind, we are in the midst of a correction, but I don't want to try to over-explain it. Markets always work in these cycles. There's the expansion cycle where assets rise and then they mean revert and correct. Gold had an extraordinary run at the start of the year, and we're going through some sort of a consolidation period where the price of gold is going to stabilize after such a strong push. I think in the bigger picture, it remains incredibly bullish, but to the levels that you're talking about, we could easily still see 22.85 or 22.50 during pullbacks, but in my mind, those are all bigger picture buying opportunities.
Now moving on to page 8, we have that uranium chart. Eric, what are your thoughts here?
Well, my view on uranium has changed a little bit, so I'm going to go into more detail than usual this week. In the long term, I remain unconditionally convinced that uranium prices are headed higher and much higher. The supply and demand imbalances in this market are immutable, they're staggering, and they're only going to get worse. But my views were greatly influenced by a video report from our friend Justin Hune over at UraniumInsider.com. Now, it was a subscribers-only video, so out of respect for other paying subscribers, I can't tell you too much about what it says. The gist of it, though, is Justin tells us the mood at last week's nuclear fuel buyers conference was very much one of complacency. The buyers are not of the opinion. They haven't been listening to MacroVoices. They don't understand the supply and demand imbalances that are building in this market and only set to get worse. They think this is just a temporary price deviation. It's all going to mean revert back down to the low side. They're not in a hurry to rush out and buy any uranium. They're happy to just wait for the price to go back down below $50. Now, that's not going to happen. I don't think they're going to get any $50 uranium. But the point is, this market is driven by a utility industry which very much can afford to take its time. If they decide to organize some kind of buyer's strike, that will eventually fail because the market fundamentals are just overwhelmingly bullish and overwhelmingly strong. But they could easily consume 6 months having it fail before they figure this out. And it sounds like from Justin's report, they really don't have it figured out yet. What Justin said was the buyers are just not concerned. The consultants and analysts are in the room saying, hey guys, seriously, it's not this 2007 spike. It's different fundamentals. It's a different story now. You should be concerned about this. Well, they haven't gotten concerned about it yet. And until those physical market buyers do get concerned about it, we're not going to see a big move in spot uranium prices. So I think what's going on here is everybody, myself included, who was anticipating this move, got a little bit ahead of ourselves, a little too far out over our skis. We bought up the best uranium mining shares, and now they're pulling back kind of substantially as some people are getting tired of waiting for this trade to happen. The least patient money is already out of the trade, and I think more impatience is growing on the part of these uranium longs. Ultimately, there's no doubt in my mind that this resolves in the final outcome to the upside on price, and that there's a really big upside move in these uranium mining shares. But until we get that underlying move in the spot price of uranium, there's no reason to expect uranium prices to move higher. And I'm getting concerned that if the buyers are organizing some kind of strike, look, in the long run, they're only sabotaging themselves, and rather badly, because they're injuring the source of capital that's needed to build the mines that are going to sell them the less expensive uranium 5 to 10 years into the future. So they're only shooting themselves in the foot, but that's not going to stop them from doing so. It never does. They're not going to see it that way. So I think this market is definitely headed to the moon when everybody, including the buyers, understands what MacroVoices listeners already know. But if the buyers don't get it, they can delay that next big move. The nuclear plants are not running out of fuel tomorrow. They only have to be refueled once every several years. And the buying necessary to support that doesn't have to happen tomorrow morning. So if they want to take their time and wait for prices to come back down, they can drag this market out, and I think that's what's happening. So the question is going to be, how long can they drag this out before the other speculators in the uranium shares start bailing and saying, we don't have time for this? I think that's what's starting to happen, and I think that could take the uranium mining shares quite a bit lower if the market takes a while before the spot price of uranium starts to move. When the spot price of uranium starts to move, which it has to sooner or later, then I think you're going to see an explosion of these uranium mining shares. But I wouldn't be at all surprised now that we've taken out the 200-day moving averages to the downside on some of, frankly, the best names, the companies like Denison and NextGen Energy and Encore, which are all excellent companies in excellent jurisdictions with no jurisdictional risk. Those stocks have gotten nailed in the last week. And the reason, I think, is just because a lot of us got ahead of ourselves and thought the spot price of uranium was going to start moving sooner than it did. Other companies like Global Atomic and ISO, symbols GLO and ISO, got completely nailed this week when other issues like Global Atomic do have jurisdictional risk associated with them. But I think the reason the stocks are getting nailed is just because of everyone getting impatient. We all thought the spot price of uranium was going to move sooner than it has. And it sounds like the physical market buyers are just not persuaded yet that they ought to be concerned about whether they're going to be able to buy uranium at any price, which I think is a very real risk. They're not concerned about yet. When they get concerned, that's when this market's going to explode. And I think there could be a deeper pullback before that starts to happen.
Well, just make the observation that the Sprott Uranium Physical Trust has had that much more selling than the main spot price of uranium. Very aggressive selling that has made it quite oversold in the short term. I still believe in the bigger picture that the uranium story is a great one. And therefore, these types of sell-offs, especially when something like the closed-end trusts like Sprott are selling at such a deep discount, is always an opportunity to fade that selling.
Again, folks, if you're interested in Patrick's special webinar, you'll find the link to register in the Research Roundup email, or you can register at bigpicturetrading.com.
That concludes this edition of MacroVoices. Be sure to tune in each week to hear feature interviews with the brightest minds in finance and macroeconomics. MacroVoices is made possible by sponsorship from BigPictureTrading.com, the Internet's premier source of online education for traders. Please visit BigPictureTrading.com for more information. Please register your free account at MacroVoices.com. Once registered, you'll receive our free weekly Research Roundup email containing links to supporting documents from our featured guests and the very best free financial content our volunteer research team could find on the internet each week. You'll also gain access to our free listener discussion forums and research library. And the more registered users we have, the more we'll be able to recruit high-profile feature interview guests for future programs. So please register your free account today at MacroVoices.com if you haven't already. You can subscribe to MacroVoices on iTunes to have MacroVoices automatically delivered to your mobile device each week, free of charge. You can email questions for the program to mailbag@macrovoices.com, and we'll answer your questions on the air from time to time in our mailbag segment. MacroVoices is presented for informational and entertainment purposes only. The information presented on MacroVoices should not be construed as investment advice. Always consult a licensed investment professional before making investment decisions. The views and opinions expressed on MacroVoices are those of the participants and do not necessarily reflect those of the show's hosts or sponsors. MacroVoices, its producers, sponsors, and hosts Eric Townsend and Patrick Ceresna shall not be liable for losses resulting from investment decisions based on information or viewpoints presented on MacroVoices. MacroVoices is made possible by sponsorship from BigPictureTrading.com and by funding from Fourth Turning Capital Management, LLC. For more information, visit MacroVoices.com.